What role does skewness play in asset pricing? The idea that people have a preference over skewness is actually not a new idea. However, in all of the asset pricing models that we've been introduced to, all of the textbook models, it is assumed that investors only care about expected return and the variance of a well-diversified portfolio. Two things. And often that's justified by some sort of assumption, such as the multivariate normality of asset returns. If assets are normally distributed, then the distribution can be completely represented by the mean and the variance. Multivariate would be mean, variance, and covariance. Indeed, this assumption of normality basically eliminates all higher moments, such as skewness and kurtosis. I guess one question that immediately arises is, what about this assumption of normally distributed asset returns? Well, it's actually not supported in the data. This especially struck me in my study of emerging markets, where the asset returns are wildly non-normal. But you don't even need to look at emerging markets. You can look at other developed markets, or even the US market, to see that the asset returns are not normally distributed. And if you really think about it, there's fundamental theoretical reasons why the asset returns would not be normally distributed. Think of the most basic framework that was proposed by Black-Scholes in their seminal article in 1973 that suggested the framework for the Black-Scholes option pricing model. The title of that article is The Pricing of Options and Other Corporate Liabilities. And they were the ones that proposed the framework of looking at the firm as a series of options. In the simplest capital structure, suppose the firm had $100 million in debt that was due next year. If the value of the firm is $80 million, the debt holders get 80, the equity holders get 0. If the value of the firm is $110 million, the debt holders get 100, and the equity holders get 10. So the equity holders only get paid off if you can pay back the debt. Therefore, the equity holders in a levered firm have what appears to be a call option on the value of the underlying assets. So in this case, even if the underlying assets are normally distributed, when we look at equity, because it is a call option on the underlying asset, and because we know that the distribution of returns on a call option is not normally distributed, therefore equity returns should not be normally distributed. So right from the fundamental principles that most equities have some debt in their capital structure, we should not expect a normal distribution. Well, I think that we can show lots of evidence that skewness exists in asset returns, but that's not enough. What we also have to show is that skewness is actually rewarded. And we have to think about this very carefully. Now, I kind of point to two examples that suggest that skewness is important. The first is kind of a simple example, and that's the lottery ticket. Why do people buy lottery tickets when the expected return is negative and there's big volatility? You could just invest in a treasury bill with no volatility and a guaranteed return. So you accept a return that's less than a treasury bill and a huge amount of volatility. Well, I think the simple answer here is that people have a preference for positively skewed payoffs, and a lottery ticket is an ideal sort of mechanism to get positive skewness. Now, I don't want to push that too far, because perhaps the people that are buying the lottery tickets are not the large institutional investors that we think of as kind of the marginal investor in the market. I'm going to push something else, and I'm going to push it hard. And that has to do with the pattern in implied volatilities on options. And in particular, S&P 500 or S&P 100 or OEX options. If we look at the pattern of implied volatilities, let's say on put options, we see the following. Look at the same time to maturity, but look at volatilities that are implied by the Black-Scholes model at different strike prices. And we see as you go out of the money, so with smaller and smaller strike prices, that the volatility increases. And some people refer to this as the volatility smirk. Now, what's the story there? Why would people put a very high implied volatility on put options that are deep out of the money? This basically means that the price of those options is higher than it would be if it was priced at the volatility of options at the money. Well, to me, this is a great example of people being concerned with skewness. If we buy a deep out-of-the-money put option, that option eliminates negative skewness in my portfolio, assuming that I hold the S&P 500. The extreme tail, the negative tail, is eliminated with the right number of these out-of-the-money options. So really what's happening here is that people are showing their preference for positive skewness versus negative skewness. Now, we can think of actually looking at this in terms of the standard analysis. The standard analysis, you draw an efficient frontier. There's an expected return, and there's a variance, and there's a frontier. There's a tangency portfolio where our utility indifference curves touch that frontier. Well, given that there's skewness in the data, and given that we have a preference for positive skewness versus negative skewness, we can expand that diagram. We can move that diagram into 3 dimensions. So we have expected return, we have variance, and we have skewness. Instead of an efficient frontier that's a simple curve, we've got an efficient surface. Instead of indifference curves that are 2-dimensional, we have indifference curves that are 3-dimensional, so that reflect our preference for positive skewness and our dislike of negative skewness. All of the same sort of intuitive patterns in interpreting this diagram that we're used to with the 2 dimensions follow right through. There's a tangency portfolio, the optimal portfolio. Indeed, the CAPM is often derived with either the assumptions that investors have no preference over skewness, or under the assumption that asset returns are normally distributed. We can eliminate those assumptions, inject the assumption that investors have preference over skewness, add the assumption that asset returns are non-normally distributed, and we can derive a CAPM. And that CAPM has got an extra term. So from first principles, we get a model. And the model has got the standard beta, and the risk premium for that beta, and it's got something else. And the last thing I want to talk about is what that something else is. This is important to realize. Skewness of an asset return is not necessarily rewarded or penalized. Just like the volatility of an individual asset return is not necessarily penalized. In terms of the CAPM, what really counts is the asset's contribution to the volatility of a well-diversified portfolio. Well, that intuition carries exactly through to skewness. What we care about is not the skewness necessarily of the individual asset return, but how that asset contributes to the skewness of the well-diversified portfolio. And the option example is perfect for this. I buy a deep out-of-the-money put, and that has an impact on the skewness of my well-diversified portfolio. It reduces the negative skewness. And something that reduces negative skewness is valuable to me. I'm going to bid up the price. So what I'm really talking about is a model that has got a CAPM standard component and an extra component And you can think of a second beta that represents the co-skewness, or the contribution of the particular asset to the skewness of the portfolio, and then a reward for doing that, a premium. All of this together suggests that a richer model of asset pricing would surely include something that investors have preference over, and that's skewness. The empirical tests of this model are rather new. Indeed, the paper that I've written on conditional skewness and asset pricing is in the June 2000 Journal of Finance. And it's rather interesting what the results suggest. That if we run this model head-on-head against the Fama-French three-factor model, this model does just as well as the three-factor model, suggesting that the factor exposures for Fama and French's other two factors could be proxying for the co-skewness of asset returns. And perhaps the most interesting result in our paper is the set of portfolios that the three-factor model has the most trouble explaining are portfolios based upon momentum. And we think that momentum contains important information about skewness and co-skewness. And indeed, if you look at the pattern in the returns of the momentum portfolios, you see that there's a sharp relationship between momentum and co-skewness. The co-skewness model actually is able to explain the difference in expected returns across different momentum strategies. So I think that there's a lot of possibilities in the future to use these models that incorporate skewness in asset pricing. Now, the last thing that I need to say is that the model is elegant, it's intuitive, but there is one major hurdle in implementing it. And that is to figure out what the expected or conditional skewness is of the asset return. Indeed, what skewness is about is behavior, price behavior in extreme kind of movements. With the CAPM, we can estimate a beta running the stock return against the market return over the last 5 years. But it's really hard to do the same thing to estimate the co-skewness, because within the time period, we might not have these extreme observations. So you have to work a lot harder to figure out good measures of ex-ante co-skewness in the data. And I propose some methodologies to do this in the Journal of Finance paper. And it's also possible that we could use options to do something like this. But there is a hurdle, and that is the measurement. It's not as simple to measure as the CAPM. It's not as simple to measure the exposure as the Fama-French three-factor model. However, the model is rich in intuition and can be derived from theory. Seems to make sense in terms of the data, in terms of my empirical examination. And it would seem like this model does have a future.